In 2009, markets were falling and it wasn't hedge funds, it wasn't insiders, it was regular workers with an automatic plan and the patience to keep going. Think of the steady paycheck investor. A small contribution. Every month, no drama. That routine does more than 1,000 predictions. Now we're entering another shift. Not a one-week headline shift. A long, structural money shift that will change what flows where. Over the next 2 decades, an enormous amount of wealth is expected to move between generations. That movement changes the whole game. The question isn't whether money will move. The question is whether you're positioned when it does. No hype here, no panic, no jargon. Just calm thinking about money, markets, and decisions that compound. Picture a school teacher in 2009. Everyone says wait. She keeps her contributions running because her system doesn't ask permission from fear. She doesn't time the bottom. She doesn't chase hot trades. She just stays invested in broad exposure and lets time do its work. Years later, the wealth didn't feel like a miracle. It felt like the quiet result of staying in the market while others stepped out. That's what most people miss. Wealth is often built in uncomfortable seasons, not comfortable ones. Now zoom out. Imagine that steady behavior multiplied by millions of households. That's how big macro shifts become real market forces. Most people hear wealth transfer and think it's only inheritance, so they mentally switch off. That's the trap. The better frame is capital flow. When money moves hands, it doesn't sit still. It gets allocated and it changes prices. A family receives assets, and suddenly there are decisions. Keep the house or sell, stay invested or rebalance, hire an advisor or go self-directed. Those choices create ripple effects. Markets, property, services, consumer spending, business demand. It spreads wider than the family. So you don't need a trust fund to benefit. You need a simple way to stay exposed to where the flow is going. The myth is one big break, a lucky stock, a perfect property deal. The math is simpler: time, exposure, and consistency. That's why broad market investing keeps winning for ordinary people. You're not guessing the winner, you're buying the system. Here's the sequence. Inheritance is the headline, allocation is the action, pricing is the outcome. And allocation creates demand for guidance. That's why big platforms like Schwab and others study how generations plan to transfer wealth. Because advice demand shifts too. Some money goes into markets, some into property, some into businesses, some into lifestyle spending. The point is not guessing, it's understanding direction. So the wrong question is, will I inherit? The better question is, how do I position calmly for what the money does next? The biggest risk here isn't volatility, it's hesitation that turns into years of delay. There will always be reasons to wait. Rates, elections, recession talk, a fresh headline every week. Delay costs time, it shortens compounding, and it forces your future self to work harder for the same outcome. You don't need perfect timing, you need disciplined participation. A plan that keeps going when your mood changes. Let me take pressure off. You don't need to pick the next big stock. You don't need the exact bottom. You don't need to feel brave. You need a system. The kind that runs quietly in the background while life stays busy in the foreground. If you feel late, you're not late. The only move that guarantees you miss it is doing nothing. Start with automation, a weekly or monthly contribution that happens whether you remember or not. Then keep exposure broad and costs low. Firms like Vanguard built their entire reputation on lowering fees because fees quietly steal compounding. Protect your cash flow before you chase returns. The most common investing failure is being forced to stop at the worst time because life got expensive. When income rises, increase contributions first. Don't let lifestyle creep absorb every raise before wealth gets a chance to grow. And think in decades, not headlines. If this is a long flow trend, don't manage it with a short attention span. That's the quiet method. Automate contributions, stay broadly exposed, stabilize cash flow, increase over time, zoom out. If you run a business, the same shift changes customer demand. Different generations buy differently, value different things, and choose different service models. The businesses that win notice where spending power is moving and adapt early, not with panic, with deliberate repositioning. This is one of the rare macro shifts we can see coming. Large research firms project the transfer will be massive, and it plays out over years, not weeks. So you don't need a crystal ball. You need a checklist, a plan you can execute even when you're tired. This isn't only about who receives money, it's about what they do next, how they allocate it, and how that changes prices and demand. If you want more calm, evidence-led breakdowns like this, subscribe. We'll keep building systems that reduce noise. And if you want the clean starting path, go to SimplifyNumbers.com/start here. Build your system once, then let it run. Quiet wealth is mostly automated behavior, repeated for long enough. Educational only, not financial advice. The goal is clearer thinking and calmer decisions. This isn't only about who receives money, it's about what they do next, how they allocate it, and how that changes prices and demand. If you want more calm, evidence-led breakdowns like this, subscribe. We'll keep building systems that reduce noise. And if you want the clean starting path, go to SimplifyNumbers.com/start here.